the S&P 500, it's not a static investment. You've got 500 hungry CEOs who've climbed up the corporate ladder, who wake up at 4 a.m. every day trying to figure out, how do I make my company more valuable, do the right things, et cetera. And so they're going to grow, right? They're going to find ways and opportunities to invest capital to grow their business, improve their profitability over time. But the rest of us, we can't handle like a 50% drawdown, which will happen periodically. So we need something else that feels safer.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome, everybody. The Bull of Wall Street podcast is back. I'm co-hosting today. It's been a while. I was just mentioning to Jim. I'm excited to be back on the podcast here. I'm Paisley Nardini, and joined by Jim Worden, Chief Investment Officer for the Wealth Consulting Group. I'm thrilled to have Andrew Beer, who's a 30-year veteran of the hedge fund industry. That sounds exciting to say. A lot of expertise and experience, though, and Andrew's actually become a good friend of mine over the last year. Another proof point that you can be competitors in this space, join forces, and do more good. So, Andrew, it's exciting to have you on the pod. I want to give a brief introduction before we jump into the episode here, because we're going to be talking about diversification. We're going to be talking about liquid alts. And I know this is a topic for many that might be a little bit overwhelming, challenging to navigate, understanding when, how, why types of questions when it comes to an allocation. And I think Andrew does an exceptional job of sitting in the advisor seat when he has these discussions. He doesn't bring a biased approach. It's really about how can we improve portfolio outcomes and why this is necessary today. So Andrew Beer is the co-founder of Dynamic Beta Investments, also known as DBI. And I think what they do really nicely is, and this is even on their website, but where sophistication meets simplicity. And we'll dive into all of this, of course, but what we're really talking about, what DBI specializes in, is really hedge fund replication. And so what does that mean? We'll unpack that. But we're really trying to distill and simplify a very complex, opaque part of the market that historically has only been available to very high net worth or institutional allocators and asset owners. And so now that this is readily available in an ETF, the question becomes, why should we allocate? How do we allocate? And so there's a big education gap. And if you're not already following Andrew on socials and such, he does a wonderful job of always providing kind of an education-led conversation on the space. So, Andrew, thank you for joining us today.
Thank you so much for having me. Now, you set the bar very high, so I'm sure to disappoint. So
yeah, that was my goal. It's like earnings expectations. So let's dive right in then. Before we get into how DBI specifically is bringing this to market, I think it's always helpful in this space to provide a little bit of a history lesson. So you guys do a lot around trend following and managed futures. Maybe let's back up a little bit here and really talk about the rise of alternatives, the rise of diversification, because you've had a front row seat to that over the last couple decades. Like, where should we start?
Well, sure. I actually think we should start on the institutional side. And I think what you've seen on the institutional side is the belief that in order to manage a pension plan portfolio, and this has become true for family offices and other places, you really want to do two things over the long term. One is you want to diversify across different things, because nobody on planet Earth has a playbook as to what's going to work next over the 3 months or 6 months. If somebody gets it right and they're lucky, they're going to tell you that they saw it coming.
Yeah, you will hear about it on Twitter.
But you don't hear about the guys who
got it wrong.
Exactly. And then the other thing is to be taught to be patient. that, that if you look at kind of the broad markets, and what it is that we're doing is we're basically taking some of our money and we're either buying shares in companies where you have CEOs who go to work every day and try to figure out how to earn profits and grow the value of their assets, or bond portfolios where you're basically lending money to people to build their businesses or do what they're going to do, and they're going to pay you an interest rate associated with it. But the whole idea was basically, if you go, dial back 30 or 40 years, portfolios were pretty simple back then. It's maybe you had stocks and maybe you had bonds. And I think, starting 20, 30 some odd years ago, a lot of people who are looking at asset allocation said, we can actually do better. That there are things that those are two great things to have in your portfolio over time. But, there are things, but the markets are not always the same. The world changes a lot. And can we think of ways or strategies of making money in different kinds of market conditions? And that was the genesis of the hedge fund industry. The hedge fund industry was somebody saying, hey, I get it. Buying equities is great. You're Warren Buffett. You can buy equities. And if you're as good as he is, you'll make a killing. But, sometimes I have a view that things are going to go down. Maybe I should short something and bet it's going to go down. Maybe I need if I have a little bit more flexibility to be able to exercise my best ideas, then I can maybe do better for my clients, particularly in market environments where they need it. Or the private equity business, it grew out of a world where there just weren't a lot of cowboys running around with money to buy these orphan companies and figure out how to turn them around and improve their profitability. And so there's been all of this, multi-decade innovation where you have smart people figuring out, how do I find ways to use my talents and hard work to make money for my clients? And the way that's translated into the overall portfolio context is people looking at it who've been making those decisions say, all right, how do we build some structure around it? And the structure came up with defining different areas. So it's not just equities. It became U.S. equities versus international equities, large cap versus small cap, growth versus value, all these different categorizations. And so what you've seen is this broad increase of complexity across institutional portfolios over the past 40 years, let's say, and it's happening in the wealth management space now. And the problem in the wealth management space is that institutional investors can often do things structurally that my sister can't do. So, there are funds out there who will say, we're only going to let you in the door if your net worth is above a certain amount. Mm-hmm. And by the way, we're not going to give you your money back for 10 years, maybe. And so you don't want to do that to somebody who might need their money in 3 years, or 5 years. So there's been this disconnect between, we know there are these really, really valuable things that we can add to a portfolio that can find ways to make money that the rest in ways the rest of the portfolio can't. But how do we then also make it accessible? And that's been, I've tried to kind of, past 15 years, I've kind of sat at the intersection of those different themes, trying to find ways to do things that work and honestly try to find ways to not do things that don't work. So that's where we are.
And if we think about the last decade plus, I think the rise of liquid alts, because that's what we're talking about here, and you just kind of alluded to that in passing, but really focused on liquidity, accessibility for all, which is why a lot of these are now packaged within ETF vehicles rather than interval funds, private funds, et cetera. So the accessibility component is massive, but they're also liquid, right? Where it's not a tale of trying to take illiquid securities and jam them into a liquid vehicle here. We're really talking about underlying liquidity within the securities and instruments that are being traded. But the last decade has seen a lot of bumps along the way, right? And I think one thing you do really nicely is you don't try to hide from those periods where these strategies may have struggled. And so thinking about where we are today, why do you see this as like kind of a ripe backdrop for the inclusion of these liquid alternative strategies, whereby maybe 15 years ago, it was an uphill battle for numerous reasons, which we can get into. We probably have time. But why today? And like, what are we looking at that provides a good backdrop for these types of allocations in a portfolio?
So I think the overall wealth management world got phenomenally lucky in one particular way, which is that somebody at some point decided that owning 60% stocks and 40% bonds was the answer. And for 20 years,
it worked.
It was amazing, right?
Yeah.
I mean, in the 2010s, people forget in the 2000s, people forget S&P made no money over 10 years.
Yeah.
Right? And yet bonds did well over that period of time. And then in the 2010s, S&P came roaring back, had the decade of all decades. And bonds did really, really well for a period of time, actually for most of the decade. And so there was a really, really strong argument. There's this tension out there between the simplest, cheapest things just seem to be working better year in and year out. And yet the people who are sitting on the allocator side are saying, wait a second, but my job is to find a way to do better, right? Sure, that's worked recently, but I've got to find a way to add something to this, to make it more resilient, to maybe add more returns over time. And the struggle that people had, the tension was a lot of those were very, very complicated. They sounded great, and they just didn't work that well, particularly relative to 60-40 that was working very, very well. So one of the statistics that I cite is when you look at this broad world of democratization, which basically means taking these complicated strategies and then putting them into a vehicle like a mutual fund and more recently into an ETF, so that my sister, just to use her as an example, can buy it and has the liquidity and everything associated with it. The average fund has done 3% per annum over a decade and a half, when the S&P has done 15% per annum. So a lot of, I think there was this, for a long time in the 2010s, there was this feeling like, I feel like I'm doing the right thing by adding diversification, yet it doesn't seem to be really adding value at the end of the day. My clients aren't happy about it. What happened in 2022 was that, in a sense, the 40% of the portfolio broke as a diversifier. And what do we mean by diversification? You've got your stocks, right? Your stocks are going to be your growth engine. Warren Buffett had this great quote. He said, if you don't have Berkshire Hathaway, what would you do with your money? He said, I put 95% in the S&P 500 and 5% in cash, for, I don't know what his multi-billion-dollar spending needs are. But what he described is basically, with the S&P 500, it's not a static investment. You've got 500 hungry CEOs who've climbed up the corporate ladder, who wake up at 4 a.m. every day trying to figure out, how do I make my company more valuable, do the right things, et cetera. And so they're going to grow, right? They're going to find ways and opportunities to invest capital to grow their business, improve their profitability over time. But the rest of us, we can't handle like a 50% drawdown, which will happen periodically. So we need something else that feels safer. And so for that 20-year period, bonds were the safer thing. They never went down more than 4%. Like they consistently, interest rates kept coming down. You kept making money in your bonds. It was just clipping out coupon for 20 years. And then in 2022, the world kind of changed. When inflation came back, all of a sudden, these things aren't balancing each other out on a ship. You basically got everyone running from one side of the ship to the other side of the ship, and the ship got very, very creaky. And so both stocks and bonds go down. And so a lot of this mantra around diversifying across asset classes, it works most of the time, but then sometimes you get into these market conditions which are very unexpected, where it feels like everything's going down at the same time. And so now, if you just dropped down, if SpaceX took you back from Mars today and dropped you on planet Earth and said, how much do I want of bonds in my portfolio? It's a much, much harder call, because they've had not a 3%, 4% drawdown, but a 15% drawdown. You have been better off holding cash over the next 10 years and not even worrying about trying to pick bonds. Now, which has in part pushed people to say, all right, we still like the idea of bonds, so let's go to private credit. Let's find maybe certain kinds of bonds that do better during inflationary environments. There are all sorts of ways that people have solved it. Mm-hmm. But the simple solution hasn't worked well. And so what people are basically saying is great, we still love that equity risk, but we need things to balance it. And our big ballast, we had a two-legged stool that worked really well for 20 years, and someone's kind of like one of the legs of the stool is not working so well, so what do we do for a third leg of the stool? And that's what's driving a lot of the interest in particularly in the ETF world where we are, of what can you add that makes clients' lives better from a financial perspective over the next 10 years, over the next 20 years, given the world that we're in.
I think too, it's important, and Andrew and I have a lot of similar conversations in our day jobs, speaking about managed futures and trend following. And oftentimes, at least I have seen that pendulum swing and the desire to have bonds in the portfolio. It almost seems like an overly crowded trade at this point where everybody's still kind of hating on bonds. But I think it's less so that it's not that bonds can't deliver based on your objectives. It's that they're no longer consistent in the way that they hedge your equity risk. And so this then enters the conversation of, well, how do we find something that is consistent, that we don't have to fear that, a Fed member is going to make a comment or Warsh is going to pivot from, dovish to hawkish back to dovish, whatever it may be. That introduces a lot of volatility and uncertainty within the portfolio. So then how do you find something that can consistently sit in the portfolio, provide that diversification, and then becomes the bigger question as well, and you briefly mentioned this, is it also needs to provide an attractive total return potential. Otherwise, most advisors are going to say, I get it, you guys, it diversifies my equity risk, but with a 3% return, it's just not going to make the cut. So as Andrew pointed out, 2022 is kind of that pivotal moment where managed futures and trend following started to pick up steam, had a really kind of attractive calendar year return. It was one of the few assets that delivered very attractive positive total return. And so we've seen a lot of that continue. And it's not without kind of bumps along the way. It's not a straight linear line up from a return perspective, but there's a very kind of ripe backdrop that's providing attractive total return potential. All the while, this space consistently is offering diversification. So maybe let's pivot, Andrew, and start to talk a little bit more about managed futures as one of these solutions within liquid alts.
Sure. Sorry, Jim, did you want to say something?
No, I just had a question before we go there, Paisley, if that's okay.
Yeah.
So you talked about the simplicity, 60-40. I love all of that. I follow all of that. Do you think part of the reason why there's not wider adoption in managed futures, hedge fund replications, these different types of strategies, assuming that people can invest in them, because like you said, not everyone can invest in private strategy. Do you think part of the problem is there's just too many choices and advisors don't know where to go, and then the dispersion is really, really wide from product A to product B to product C? Do you think that's it? Or do you think people are just still kind of anchored to 60-40?
Well, I think it's, I think the bigger issue in the wealth management space is we talk shop, right, about correlation. So when I talk about bonds failing from a diversification perspective, I am talking about the fact that the Bloomberg Global Ag and the MSCI World had a daily correlation of 0.76 this year. And that, 98% of end clients could not care less about that, right? They are like, okay, a quarterly checks are showing up in my
Sure.
bank account every quarter, and it's more than zero, which I suffered through for years. So I think the challenge is the tension between advisors, asset allocators, model providers who are thinking, my job is to help you retire in 10 or 20 years with as much money as possible and give you the smoothest statistical ride between now and then. That's how I help you. Then you go to clients, and clients are like, well, why do I have $50,000 in this when I could be buying a new Ford Mustang? Or why am I doing this when I'm buying it? So it's, I think that's the that's the fundamental. I was talking to a guy at one of the major wealth management platforms yesterday. He said 2% of their advisors have investment in alts. 2%. And these are, considered to be elite advisors who've been selected at one of the top wirehouses. So, and I think that's the tension that's out there. So what we found is that there are a million different types of allocators, a million types of different firms, and And I think when you get down to the allocator level, the questions that you're saying are absolutely true, because the wealth management, the asset management business is a business where people create a lot of products and they have huge sales teams, and their job is to get you to buy it before it goes bad, basically, right? They don't offer money back guarantees. The guy who sold it to you 3 years ago and has moved on to a next job 3 years, by now, and he got paid on it and he's fine. So advisors are often left holding the bag for things that don't work well, and they're bombarded with spin. And I think one of the things that people have said about me in this is that, and I think Paisley mentioned it by saying, is that I've always tried to sit on the other side of the table. Like what do I build today that I can stare you in the eye 10 years from now and say that was a good idea?
Sure.
And if the answer is I'm going to build 7 things and hope one of them works, that's not a great answer. If the answer is I'm going to bet my career on this thing working, and I'm not going to get distracted by doing 25 different things, then just me as an allocator, I would have more confidence in that. So I think ultimately the allocation side, there's also a tension between trust of the person who's making the decision, how they're making the decision, but also understanding that people should be very, very skeptical of the stories that they're being told. But it's hard. I mean, I've known some incredible hedge fund managers who are extraordinarily unpleasant to talk to, because there is no conversation that doesn't turn into a fierce debate about economic value. Are you getting a latte? Why would you get a latte when the cost of milk is this, and you can ask them for heated milk, and the cost of coffee is that? There's a 32% arbitrage. I'm like, I just wanted the latte. Okay, it doesn't really
I'm
matter.
Guilty of that. I used to order a soy misto at Starbucks because you could arbitrage. Okay, anyway, I see where I sit on this.
But so look, I think that's ultimately, is an advisor better off delivering a statistically inferior product to a client? But if the client doesn't know better, the client, I gave this talk in London about this issue, and I had 12 slides talking about the strategy and how it could help statistically sharp ratios, efficient frontiers, dive into that stuff. And my 13th slide, and none of your clients will care, because they're not going to come back after 20 years and say, thank you, my Sharpe ratio was higher, my risk-adjusted returns were higher. They may care in 2022, right? When there's flames coming out of the windows and you found something for them. Paisley mentioned this category that I love was up 20% in 2022. Like, how great is that, right? When it's September of 2022 and stocks are down 20% and bonds are down nearly 20% and commodities were up, but your REITs are down. Everything is getting hit at the same time.
Yeah.
And we used to call it a beacon of green and a sea of red. Like that's really valuable in the human interaction. But then you also have to way of having this be somebody's portfolio over time. So the next time that happens, they're also invested in it. And that's the challenge.
Makes me think of like tail risk hedging and some of those strategies, the black swan type strategies that, you're losing money. It's death of 1,000 paper cuts. And then that one time it works really, really well. But then do you want to pay for it over time when it's not working?
And are you going to hold it? Like, are you realistically just seeing? It's like big insurance policies. You can do things with big insurance policies, but people use like, and so I think those are all the challenges. And I think what I'm seeing across the space is that again, that's what I realized with my business is if I don't understand what makes an advisor or an allocator's life better, truly better, in the way that they define it, right? Their clients have picked them, right? There's something in their messaging that resonated with those clients. There's something in that relationship. And and I will tell them, if I think that what we do doesn't help them in the context of that, then I'll be very open about it. Because ultimately I think this is a business where I think the asset management business is a business where a lot of people have gotten rich by, I wouldn't say fleecing people, but like if you launch 6 funds, there was a friend of mine worked at Fidelity in the 1990s, and he told me a story about how they would launch 12 funds every January. And by June, they'd shut 6 down. And by the end of the third quarter, they'd shut down 3 more. At the end of the year, you'd start seeing ads. Top performing 12 months, like conduit. And so look, this is a business with the people who want to maximize their own profits. We're going to be very, very aggressive about trying to get you to buy things. But what I've tried to do with our business is basically say, look, we'll be totally upfront about you with the decisions we made, why we do it, because I'm not running one of these profit maximizing short-term businesses. I want you to be my clients in 10 years. And the only way that's going to happen is if what I do works the way, and I explain to you clearly what it is that we're trying to do.
So
Andrew, go ahead, Paisley.
I was going to change topics, Jim. So if you have more questions on that, go ahead.
No, go ahead.
Okay. I thought it might be helpful, as we mentioned, one of the most consistent liquid alternatives from a diversification standpoint has been trend following or managed futures broadly. And so I think for a lot of investors, this is a very unknown part of the investment, market. And so how can we help our audience understand what is meant when we say managed futures? Kind of what is the history of this? I actually find when I'm having to explain this to investors or to clients, it's actually a lot more tangible than we think it is. It sounds unknown. It sounds scary, sounds opaque. But would love for you to just kind of overview, like very quickly, kind of the history of managed futures and why this is a great tool to really kind of navigate market uncertainty and be a diversifier in the portfolio.
Sure. So it's a really, really fascinating strategy. First of all, it has the worst naming conventions ever. So managed futures, it's very hard to pinpoint what exactly that means. Trend following sounds like you're kind of late to something. They used to call it CTAs, which is just a regulatory term. What's really, really interesting about the strategies, I mentioned this idea in the beginning about if you can do more things, there might be more opportunities. Like if you're not just confined to buying stocks and you can also bet on stocks going down, okay, that if you have good ideas, that's another way to make money. But what if you did it not just in stocks, but you did in stocks and bonds or interest rates? What if you then also did it in currencies? What if you did it in commodities as well? And so what the strategy is basically, and the reason it's called managed futures is because if you want to bet on, if you think UK interest rates are going to rise, the way you do that is through these investing, basically these things called futures contracts, which allow you to very, very easily basically make these series of articulated bets. No different than if you believed in Microsoft and you bought Microsoft stock. So for the more financially sophisticated, these are incredibly efficient ways of making these discrete bets. What the space has shown in the most non-technical terms, what it's shown an incredible ability to do through using these computer models is basically identify early on some big changes in the world. And the big changes in the world, why do I say changes? Because they're going against the consensus view that everyone, the people who are building model portfolios, Wall Street analysts or something, have a particular view of the state of the world, a particular expectation that's going to happen, and they start to see evidence that somebody, smart money, somebody else has a contrary view, and so they end up being early and right in some really important trades. And so, just to give you some examples, if you remember during COVID, right? So in the summer of 2020, it was bleak. Okay, like we were going into a global multi-year depression, right? The economies had shut down globally. I mean, it was really dark. And what people thought was going to happen was not that we were going to have inflation, but that we're going to have really bad deflation. And deflation, in some ways, when you're getting to, that's even worse than inflation. Mm-hmm. And so people thought the yield on U.S. Treasuries was going to be negative. Like, how could you have a negative yield? You buy a Treasury and you pay the Treasury every quarter. But there was already $18 trillion of debt out there that globally, where people were paying money to own fixed income. And So what happened was it didn't go negative. Treasury yields got down to 0.5% in the summer, and they started to creep back up. Right. So the consensus view was they were going to go and go down negative, and some people realized, oh, that's a little extreme. Right. That's not so. And maybe they were thinking about Operation Warp Speed and trying to, and solving COVID and what people were going to do. And so we had Fed stimulus. And so these guys started betting these managers in general started betting that interest rates were going to go up a lot. And so in the fall of 2020, we see them and they basically start betting. And the way you do that is these futures contracts, which make money if interest rates start to rise. And so what they ended up doing is anticipating the return of inflation. And it wasn't even until January of 2021 where people started talking about, great, we've had this crazy Fed stimulus going on. We've got things coming out of Washington, D.C. The Democrats just retook the Senate. And that this was going to, these factors were going to drive this kind of this big increase. But you had supply chain issues, all these kind of converging. And so think about how valuable that is from a portfolio perspective. That's why in 2022, when inflation really did kick in, these guys had gotten in early. And it was part of the reason they were up more than 20% in 2022 when inflation was no longer theoretical, but was really happening. Or gold. Gold was bouncing around. You go back to 2010 and people were like, buy gold. Did nothing to get here. 2015, buy gold. Does nothing.
Doesn't do anything.
2020, buy gold. Like gold was supposed to save you from inflation. And 2022 hits and everything moves but gold. And then gold starts to move. And sort of after 2022 has happened, gold starts to move for a different reason. And these guys start buying gold around 2,200, 2,100, et cetera. And again, what we're doing is basically mimicking their performance and then to ride it all the way up to 5,500. Earlier this year when crude oil was just starting to, you're seeing like indications that maybe something wasn't terrific in the Middle East and crude oil started to rise a little bit. They see that as an early sign and they're long crude oil when war breaks out. So the strategy.
Andrew, just to clarify, when you're speaking about positioning and kind of capturing some of these opportunities early, are we speaking through a discretionary lens or through kind of more of a systematic model-based approach?
So all of these guys that I'm talking about are using models. They basically are, you've got a bunch of guys, propellers spinning aggressively around their heads who go into the office in the morning and they're running models that are looking at all different sorts of price and data, trying to come up with their own views. What we do, which is a little bit different, is we look at what the biggest guys in the space are doing and basically say, what are the big things that if all these 20 guys believe, on average that oil is gonna be going up from here, well, let's honestly just follow along with what they're doing and copy what they're doing.
Replication,
right? If sometimes cheaper is better.
And I'll loop back to that because I want to spend a decent amount of time kind of breaking this down because we want to set the stage of like why this is an attractive asset class. And then I think how you guys have built a better mousetrap per se on how to access it. So I think too, one thing that you just mentioned was 2022 as an example. And that goes back to one of the questions that Jim had asked in regards to like this being labeled like tail risk hedging or crisis alpha. And so how do you see this category broadly kind of towing the line between just being crisis alpha or just being this kind of all-weather strategic diversifier? Because I think, at least I see firsthand, advisors use them in different ways.
Well, look, everyone likes it more when it's up 20% in 2020. We're up 23% in our strategy in 2022 when everything else is down, right? But we're up 25% over the past 12 months. And
we're recording this, like that's like through like the end of June, second quarter of 2026.
Exactly.
Yeah. So like it's been obviously a bumpy year, but we have not had really anything catastrophic that lasted more than maybe a week or so.
Well, it's because remember, these guys can also be betting on things getting better. Right?
Yeah.
And so right after Liberation Day, part of what happened was, I mentioned during COVID, people got excessively pessimistic. After Liberation Day, a lot of professional investors were excessively pessimistic. And I mean, I think Bill Ackman called, so like self-inflicted nuclear economic annihilation or something like that. I mean, there was a lot of
Nice
hyperbole
bedtime story.
about this. This is before
Sure.
the FT had coined Taco Tuesday, and so you can also make money in these strategies so equities have had a tremendous 12 months that few people predicted 12 months ago.
Mhm.
So if you're early and you start seeing signs of it and you start adding to your equity exposure before equities start to soar, that's hugely valuable. So I view it as an all-weather solution that happens to have the feature of when the consensus is really wrong. I mean, I've never seen a situation where the consensus is we're going to have a down 30% bear market. Down 40% bear market. What happens is the consensus is always bullish or somewhat concerned, and then it happens, but then something starts to escalate. A couple things happen at the same time. In the GFC, there was one weekend in September when it looked like Lehman Brothers was going to be bailed out by Barclays. And then we found out in the morning the Bank of England basically told Barclays, okay,
No.
not on our watch. And then boom, like it starts cascading and the whole financial system freezes up. But if you're already betting on the possibility of catastrophe happening when that happens, then it's a great money-making opportunity. And so what I loved about the strategy was that, we're not trying to, it doesn't make somebody's equity portfolio better. It doesn't make somebody's bond portfolio better. Like those are already, or lots of different things, but rather it brings something to the table that just the average advisor or allocator will never find a way to capitalize on themselves.
Andrew, do you think that's just because it's focused on trend and its model and it's we're removing, I guess we're kind of removing some of the human behavior and what are the pundits saying, and we're just looking at price and we're saying, what is it doing? It's starting to move up. We want it, or it's starting to move down. We want to short it. Do you think that's the reason why these things work?
Yeah, it's the models are ruthlessly cold and rational. And so as a human investor, I mean, I often say that that hedge fund managers were the first behavioral scientists, because even the great hedge fund managers get fooled by your own desire to avoid missing out on an opportunity or your fear. And like, I remember when I used to try to pick stocks and stuff, something starts to go down. You're looking for somebody knows something I don't know, like, what did I miss? And if it goes badly, like, am I going to be embarrassed by, like, all these kind of human things come into it. The models, in a sense, it's a little bit like when you're dealing with a Chat GPT or a Claude. They'll get things wrong, but they'll do it fast and they'll do it shamelessly. And so, these guys, so the way these models work is you've got to be prepared to be like, hey, it looks like it's going to go up. Oh, sorry, never mind. It's going. Oh, wait, am I going down? Oh, no, never mind. So you've got to be able to, like, it's the coldness of going in and out.
Yeah.
But then when it starts to really happen, you'll have been in early enough and you'll have conviction to stay with it. There's one of the, like, for instance, if you had bought gold at 2,200 and thinking it was going to break out to 2,500 or 2,600, would you have held it to 5,500? Like, most people won't, right? Most
people wouldn't. They take their money and they cash out.
I'll take my trips, honey, I bought you something. So it's the coldness of the models, the sheer rationality of them that gives them a huge advantage as tactical, as basically, and this is ultimately a tactical strategy. And they're much better at it than human beings are.
And I feel like that's probably a good opportunity as well to mention, because I receive this question often, which is, should I tactically time my entry and exit and manage futures? Should I strategically hold this? And I mean, I think the common answer here is, like, to market time something that's also market timing just is compounding the ability to make an error. And really, it's the beauty around the unbiased, unemotional approach to capturing opportunities to make money, whether it's up, down. So maybe it would be helpful now to kind of pivot the conversation into just the uniqueness of all the individual strategies within this category. And so you talked a little bit about long, short. Usually these are more unconstrained in nature. Equities, rates, commodities, currencies. There's a lot of levers that can be pulled, a lot of different investment horizons or trend horizons that can be viewed, rebalancing frequency. These are all inputs that each manager and each strategy selects from. And so I think, Jim, you mentioned this as well, is just the higher dispersion nature of this space, like any alternative type category, because they all are unique in their own respect. So, Andrew, as it relates to selection within this respective space, knowing that it's not, 30, 40% of the portfolio for most advisors. So if you're only thinking about carving out a portion of your portfolio for this, what types of decisions do you need to make because of the uniqueness of all the strategies in this space?
Well, I think so. It's a very, very difficult space historically, it's been a very difficult space to get right as an allocator. And for the following reason is that there has never been something like, for instance, if I said to you, build a 60-40 portfolio with one stock and one bond, that's really hard to get right. If you got NVIDIA, great. Okay.
NVIDIA and then a 100-year Disney bond, we're done.
Whatever, right? So even within the space, what happens is that of the 20 big managers we talk to, all of great reputations, the difference between the top and the bottom manager every year might be 30%. And no one on planet Earth has been able to figure out in advance which one's going to be number one and which one's going to be number 30. And so it's the same thing with equities, right? Equities, it's so random which one's going to do well.
And we'll typically see whoever leads this calendar year might lag the next calendar year. So there is a lot of ups and downs as well.
And in this, and what people tend to do is when they're selecting the funds, like who's the best fund in the space, I'm going to pick the one who's gone up the most, and then that ends up being the one who does the worst. So one of the challenges has been, we know the space is great broadly, like equities are great broadly, but how do you get exposure to the broad space as opposed to taking on all this risk of picking the wrong manager? Mm-hmm. And so the approach that we took was basically to say, how do we mimic the exposure of the whole space as efficiently as we could? So if the 20 geniuses out there are collectively buying gold, maybe we don't need to pay them a lot of money to buy gold for us. We know how to buy gold. If they're buying crude oil, well, we can kind of do that ourselves, and we can do it much more efficiently. So the way, but rather than trying to figure out which of the 20 was the best, to say we know the whole space is great on average, as a very, very valuable average, but let's try to figure out if what these guys are doing on average. There's a concept called the wisdom of crowds, and it goes back to, you'd have a fair or something, and they'd have the number of marbles sitting in a jar, and 100 people would randomly guess, and turns out like the average guess looked a lot like the number of marbles. So there's this idea of basically the collective wisdom can actually be very valuable. And so we looked at it and basically said, how do we get that as cleanly and as efficiently as we can, and then put it into a really client-friendly wrapper like an ETF or the funds that we manage in Europe. And so what we found actually was that, almost in complete shock to everybody, but like me and my two partners, when we did our original research, was actually we can make it work in an ETF and do a lot better than hedge funds, because this is an area where its efficiency is such an advantage. If I told you I'm going to run an equity portfolio here and I'm only going to pick expensive mutual fund share classes, it's going to be really hard for me to pick the right mutual funds to beat the S&P 500 at 3 basis points. And so, but it was that basic idea of, let's try to distill what they're doing down into the really big, most important trades, because we know that's really what we care about. We care about the return of inflation. We care about war breaking out in the Middle East. We care about whether we're in equity markets are soaring or going down from here, or interest rates are going up or down. Let's distill it down to that, and then all of our energy goes into efficiency and accuracy. And so the crazy thing is, we've been doing this for 10 years and looking at the space, and we've outperformed virtually every large hedge fund on not even an absolute, but also a risk-adjusted basis. Mm-hmm. And with something that is so much simpler than what the actual hedge funds do. And it really all comes down to efficiency. You can have a gas-powered engine with 2,000 parts, or a car with 2,000 parts, or you can do an EV version. And the EV version may be less fun to drive sometimes. You don't have your old manual gear shifts, but 0 to 60, it probably does better. So it gets you to the same place. So it was really about kind of bringing almost like a technological innovation. Great space. We love what you guys are doing, but maybe we can take this great diversifier, which has all these great statistical benefits, and make it into a great investment. And that by being more efficient, basically have more money to go back to our clients.
And I think that piece that you mentioned is so powerful, because a lot of the legacy hedge funds, we know they're just littered with fees, right? Layers of fees, performance fees, high watermarks, management fees, et cetera. And so what Andrew and team are doing at DBI is, by kind of removing that fee level, that is alpha that used to be in the pocket of the hedge fund manager, that you've now put in the pocket of the investor. And so I think very simplistically, going back to how I was introducing your firm, is like where sophistication meets simplicity, is like sometimes the things that are more boring and straightforward are actually the better ways or more efficient ways to make money for your clients. And so I think how you guys approach this market is, there's a lot of strategies out there, and it's not to knock the ones that are more complex or more nuanced. There's some that are trading, over 200 markets globally and getting into really niche, unique parts of commodity markets in Southeast Asia, for instance. And then what your guys' approach is, like you said, is like, what are those major themes? How can you capture a majority of how markets react to that theme? So you're going to find at any given point only 10 individual markets that you guys are trading in, which at the surface might seem kind of simplistic and boring, but to your point, the results speak for themselves. So I just think it's a really innovative approach to accessing this space in a way that most people kind of, wow.
Yeah, look, I think it's, again, I'm not a quant, right? So my whole investment life, which is now 30 plus years in the hedge fund industry, and I worked in private equity briefly and an investment banker, is most good investment ideas are grounded in a relatively simple and straightforward thesis. And so you can hear a hedge fund manager who's done all this work to come up with a very, very complicated thesis. Often the way they implement it is very simple. Like, if you have analyzed every tanker in the world and how much oil is sitting in every storage facility in the world, and you can do all that analysis all day long, and you're probably going to buy or sell liquid oil contracts to figure out how to get exposure to it. So now there are times when you have to do it in a complex way. Back when I was a more, kind of like normal hedge fund manager, there are things that required a lot of complexity and a lot of work, and you get compensated for it, because I remember buying things at 20 cents on the dollar, right? And months of work would go into it, and you'd buy like this much, but boy, it was cheap and you could make a lot of money. It was impossible to lose money on them. But as an intelligent investor, you've got to make a decision. When do you need complexity, and how much additional performance you get from complexity? How much additional returns you need for illiquidity? And I think that's the challenge that we're seeing in a lot of the traditional alt strategies is, why am I investing in private equity if the returns are roughly what the S&P can give me? Why would I pay somebody 400 basis points to just give me what I can get in a liquid 3 basis point product? And I think that's where, again, it goes back to kind of the structure of the industry and what people are trying to solve, and it may be different tomorrow. but I think what we're really just trying to do is build things that would help people when they're building their portfolios, just make them better, and to try to deliver something that would help them through all different market conditions. And if you have something that's too expensive, with too many fees piled on top of it, you're going to go through periods that aren't as good as other periods, and that's when it crushes you. Because that's when people say, "Why am I doing this if I'm not making any money?" So in the ETFs we manage, we've done 9% per annum in over 7 years. Like that doesn't feel like you're giving up a lot. That doesn't feel like you're throwing money out for insurance. And if you can have that and happen to have a bunch of those returns, like 23%, come during 2022, I think that's something you can have in your portfolio, not just because you think next month there's going to be a crisis, but rather something you can hold over 10 or 20 years.
So Andrew, I wanted to ask you about that. Years ago, I was doing due diligence, met with a lot of these different CTAs and hedge fund shops. I was out, beautiful to be out in Greenwich and different parts of Connecticut. But, my question is, like, I feel like there's still funds that still charge a lot. The fees are still a very, very high amount. And then you've got, you mentioned the complexity. Some of these strategies have their own weather forecasters and things like that. I mean, they really, really get it. At what point is the cost to produce the alpha just so big? Mm-hmm. But they can still justify it because they're still charging like 3 and 30 or 2 and 20 or whatever. I mean, I feel like at the end of the day, what you're doing, replication, is just saying, well, I want to own all of them, but I'm not going to pay them all those extra fees. I just want to know how they're doing it. Mm-hmm. I'm just curious, like, because I feel like the alpha, some of them really put too much weight on, this is all alpha, very little beta, but I mean, it's probably a lot more beta if you compared your returns with some of the things they're doing.
Well, so there are, first of all, I have a nuanced view on fees, right? Sometimes they're worth it, right? There are funds out there that are doing things that are so sophisticated and finding, like this guy named Ken Griffin started this firm called Citadel. He's basically, he owns Miami right now. That's like having Lionel Messi, that's LeBron James. I mean, he is so talented and has built such a hungry organization that even if you pay them a lot of fees, they will find, like, they have literally, the Financial Times wrote an article on them. They probably are the best weather forecasters in the world. They may be the only people in the world. If you are a good weather forecaster, you are getting hired at Citadel for some astronomical fee. So they are even in 2022 or I think 23, 25, they may be the only people in the world who can forecast weather out a month or two.
Interesting. But that's alpha, though. They're adding it. You're paying for it, but you're getting excess return. Right.
If they're delivering, 15 points of alpha a year, and they're taking 7, fine. Okay.
Sure.
It's a lot of the industry, though. It's funny. Like, if you look at the mutual fund world, there are mutual fund world companies that are trying to become ETF firms now, but they've got this big, heavy, legacy, high cost mutual fund business. And they're kind of like putting on their running shoes and like, look how nimble we are on the ETF side of our business. And it's the same thing with hedge funds, right? So every hedge fund has a legacy associated with it. And the reality is, until people like us came along and certain other things that have kind of challenged the orthodoxies of it, you didn't have a choice, right? You either invested with them or you didn't. And there's a lot of the industry is, like on the institutional side, if your job is to go pick hedge funds in this space, you're going to pick a couple of them, regardless of whether you think it could be done more efficiently. One of the interesting things about our business is we beat hedge funds, but most institutional allocators are not interested in talking to us because they've gone to their investing committees and said, you need us sitting here to find you the great hedge funds. Well, 10 years later, in this particular category, you know what the answer is. It's a better investment to do it efficiently. You will save a lot of time, but what you're basically saying is fire me, because then you don't need me anymore. So rationally, they're not going to do that. They're going to keep rearranging deck chairs in the Titanic. So there are certain, what we've done, I think, and like what I'm proud of in our business, I mentioned kind of we try not to do stupid things. What we do works incredibly well in two circumstances, and it doesn't work well in other areas. So you cannot replicate a lot of hedge fund strategies, and you shouldn't try. The problem people have had with the liquid alts world and the idea of democratization is sometimes they take things, they get fooled because they see something that worked well in one context, and they think it's going to be easily repeatable when you try to put it into a liquid mutual fund. It just doesn't work. I don't know if you remember, about a year ago, there was all this talk about putting private credit into ETFs. Just a bad idea, given the structure of it. So, but again, this goes back to this great pressure for people to introduce new products. And so look, we brought a fresh perspective. I think we're the only firm that offers daily liquid, low-cost products, where every product we've launched have beaten the hedge fund benchmarks. But that's also because, again, we say we don't do stupid things. Like that guy, Ken Griffin, don't try to replicate his fund. You cannot replicate their weather forecasting team.
Yeah.
With regular instruments, so you shouldn't try. But you have to, you can't. I don't even know. You probably can't get into the funds anymore. You probably have to write them a $25 million. Yeah. You're lucky if you don't ever expect to get your money back in a short period of time. And so there are those things that are going to still be out there. But we've just tried to focus on the areas where we can add value and be laser focused on that.
So, Andrew, over the 10 years that you've been running this, have you found that it's easier to get the signals and identify the beta, what they're doing, to build that in the portfolio? I know, we talked to our friends over at Goldman Sachs, and they do hedge fund replication too. It's not the same thing, kind of what you're doing, but they've been able to get better. Part of it is because they can see exactly what they're doing in some cases. But I feel like with AI and technology, I mean, is that something that is kind of shaping and fine tuning some of the work that you're doing?
We haven't seen it on the investment side, interestingly. What we are seeing, first of all, AI is incredible, right? And it introduces efficiency. I mean, we're a very unusual firm. We're $7.5 billion in AUMs and 7 people, and AI makes us more efficient. It makes programming easier, but the core investment idea that we came up with hasn't been impacted by AI, and I don't think it will be. What we're finding with AI that's very, very interesting is it's helping advisors to think through diversification decisions. Because a lot of advisors want to add diversification, and they know, but that's going to be a statistical exercise.
Sure.
That's going to be saying, what if I added this to my portfolio and really made it better? But when you start doing that, you get into some of the issues we described. What index do you use? What fund do you use? How do you look at it? What we're finding with AI is that it's equipping allocators to, if you ask Claude the right questions about diversification, and you say, hey, I'm interested in the space, managed futures, you will get, it's the equivalent of hiring a dozen PhDs and sitting them on this industry for a month and coming back with a report. It's incredible. And what it's doing is it's making allocators more comfortable of the value add. They're not missing anything. Because the challenge you have when you look at these products is somebody comes in and they say, hey, look, our portfolio's manager's name is Rumpelstiltskin, and he's found a way to spin straw into gold. and you don't have the time to compare him to 10 different people. You don't have the time to go research the 12 different funds in the space that were shut down. You don't have time to ask these guys about their 5 different funds that crapped out at some point. And so people are always afraid that they're going to miss something, that there's some preventable mistake. I should have looked at this. I should have done that. And in 2 years, I'm going to be trying to explain to my clients. They're going to be saying, like, how did you miss this? You said this was great. It didn't happen. And so what I think AI is going to do is it's becoming a very, very, very powerful way for advisors to be able to make sure they're not missing anything, and to be able to articulate that if we're going to help you with that goal of retiring with as much money with the safest ride between now and then, we need more and more things like this to help us weather the markets. The playbook is going to change over time. And when you rank all these different things you can do, this strategy happens to rank near the top. You just don't find many things that can do well in both a year like 2022 or the past 12 months.
Yeah.
Back to your point about tail risk, right? I mean, you would have had a month to make money in 2020, a little bit of time to make money in 2022, and the rest of the time you are hating it. So,
you're losing money. Yeah. Which is hard for people that because we're all human beings, and to see that over and over, the statement risk, right?
It's very hard. Yeah. And I think again, it goes back to the human element. I mean, if we're going to succeed, and look, my goal is that in 5 years, the vast majority of people look at their portfolio and they say, okay, I've got a 3% or a 5% allocation to this. And we're trying to make it easy, right? It's not, it's either, if I don't have Lionel Messi, I don't want to be, I'm not going to, I don't want to be in the soccer business. If I don't have this guy, I don't want, it's like, no, it's a great area. It's a great area, but you don't have to invest in a hedge fund. You don't get K1s, you don't have, this is an easy to invest in ETF, no different than buying a gold ETF or a XYZ ETF that just helps you to bring diversification to it. But it's got to be, people have to feel that when they look at this allocation, their portfolio, they got to feel like, you know what, I'm glad. I understand why that's there. I feel good having that there, particularly. And if the markets equity markets continue to be as completely as insane as they are right now with these wild factor rotations and 3 years ago, the Mag 7 were the best companies in the world because they were generating cash. Now they're, turning cash flow negative. I mean, it's just, the world is changing so fast and in such a big way that it's definitely time to make sure you have your bases covered, you have more diversification, because we just don't know how this is going to play out.
Interesting. I've got one more question, if you don't mind. I know I didn't realize the time is flown by. We really, really appreciate your being on with us, Andrew. My last question. So we run some quant strategies. They're quant driven, so they're still actively managed. But we're looking at 4 factors that everyone know about. It's quality, it's momentum, it's low volatility, it's value, right? But then we add trend in there too, and it's done well. Why do you think there's not as many quant strategies, or maybe just active managers that are using trend, or maybe they just don't say they're using it? But why do you think that is? Because we know it works.
Oh, I think everybody's there's a different answer for everybody on that. I talked to an asset allocator who part of their pitch was that they were tactical, right? Yeah. That they're not sitting on their hands with the markets change and they're going to do things. I looked at their portfolios. They didn't change their portfolios very much, but that's kind of their story, right? And what if our portfolio is positioned a different way? What if so I think everybody has a different narrative and a different history. The traditional equity factors that you've described. Yeah. It's, again, those are pure equity factors, right? And trend is a multi-asset thing. It's equities, rates, currencies, and commodities. Where do you put it? And historically people used to throw it into the hedge fund bucket. Even within the hedge fund bucket, and that's why I think the best way to think about it is its value is relative to the rest of the portfolio.
Everything else. Yeah.
Everything else. And a guy that I was talking to about it, who actually reached out over LinkedIn, he had a really interesting thing to say. He said, everything in my portfolio is static. Like if I'm in the S&P 500, okay, the S&P 500 is going to go up and down, but the constituents aren't changing every day. And what the companies are doing, it's all very, very slow moving and strategic. Same thing in my bond portfolio. portfolios. Same thing, private equity, private credit, et cetera. And he said, this is the one area, this is the one asset class that's dynamic, that's tactical.
Yeah.
And so he said, it makes my whole portfolio more nimble, because I don't want my whole portfolio to be nimble, because that's going to drive me insane. And I know there are times like, I don't want to be worrying every time Liberation Day happens or the war starts or something, like de-risking, not risking, getting out or whatever. But even a small allocation to this makes the whole portfolio more nimble. It was really compelling. It's a very, very
interesting.
Yeah.
Yeah, I like how you frame that.
Right. His idea, not mine. Alex, it's to you.
Yeah. Well, thank you for sharing. And I'll echo Jim's comments on, we just really appreciate your time and your insights. I think the goal of today's discussion was to really put managed futures, trend following liquid alts on the radar of advisors. I think at the end of the day, when it comes down to making an allocation, it doesn't need to be as scary as many think. Like, this is not an overhaul of the portfolio. This is not getting rid of all your bonds or carving out, 15% of your equity book. This is really, at the margin, as you would an individual security or an individual fund. Allocating anywhere from 3 to 5% is typically what we see from like an institutional lens that helps move the needle. So I say that because oftentimes, and this goes back to what you were sharing, Andrew, is like when people have interesting, innovative strategies, they're kind of shoving them down at everyone. And hey, you need to overhaul your portfolio, or you're missing something. It's this fear mongering. And this is really just improving through a more cost-effective, efficient way to think about diversification. So appreciate you sharing all that. I'll reiterate what I said at the top of our conversation, which is that if you're not already following Andrew on LinkedIn, highly encourage you to do so. He's also really great at sharing what else is going on in this industry. His belief is like, let's grow the pie together, because it is still a very nascent part of the market. So thank you, Andrew, for joining us today on the Bull of Wall Street. And thanks, Jim, for co-hosting today.
Yeah. Thanks, Paisley. Thank you, Andrew.
True pleasure to be here. Thank you guys so much.
Great conversation. If I'm ever out in Greenwich next time, I'll have to drop by and say hello.
Come by. You can see the guys who are charging more than us.
Here's Three's company too. Come and dance on our floor. Take a step that is new.